Welcome to Firstline Compliance's Carefully Off the Cuff.
Hi, everyone. Welcome back to Carefully Off the Cuff. I'm Josh.
And I'm Ray at Firstline Compliance. Hey, today we're going to talk about something that I think is pretty important, although sometimes you might not think so, but it's a value proposition. We actually have a good guest today, Michael Snelling. We're going to talk about, of all things, bond and insurance coverage, what they are, how do you use it, and I think that sometimes we don't think about it. I think these days maybe we'll think about it more. So Michael Snelling, I've known for years, Josh as well, and he's from Hub International. And frankly, from my experience, and maybe I'm biased, but I'll tell you, man, he's the mortgage insurance guy. Sorry, the insurance for mortgage company guy, to be clear. So thanks, Michael, for joining us. Do you want to kind of introduce yourself a little bit?
Oh, yes. Thanks, Ray. Thanks, Josh. Michael Snelling, Hub International, located outside of Sacramento, California, but licensed in every state. Really dove into the lender and broker avenue on the financial institution side roughly 8-9 years ago. Noticed that there's gaps and there's missing items within coverage, within policy forms that people that don't specialize in this niche don't know and don't pay attention to. So really here just to put together comprehensive insurance solutions, make the process as easy as possible for all clients and potential clients, and just know that you can sleep well at night if something were to come up on the insurance side.
Let me just jump in quickly because Michael is humble. Ray stated it, I'll restate it. Working with Michael, and as you know, we do a lot of licensing work at Firstline Compliance, work with a lot of clients on a myriad of issues where insurance may come into play. And Michael really is the best that I've been able to work with. His responsiveness, his ability to insure, his knowledge of the information really is top notch. So not to be the totally unashamed plug, when you got insurance questions or needs, Michael is your guy.
Sure.
For today's presentation or talk, I just kind of want to start. I actually think there's some commonality between mortgage and compliance, and really that is almost nobody wants them, but we all need them. And if you don't have the right insurance or you don't have compliance, you're going to find yourself in a world of hurt. So Ray, let me let you kind of kick it off and go into some of the questions that we were walking through.
Thank you. Yeah, thanks. Hey, so, and I've in this business for 30 something years, right? And I know we've signed off and reviewed insurance, et cetera, but I still get confused sometimes. I think most people do. Let's talk about the insurance types. I know there's bond, and you get a bond when you get a license, right? Whatever that covers. And by the way, you handle that, Michael. Then there's E&O, and it's like, well, you cover that, Michael. Then there's D&O, and whatever that is, but Michael, you covered that before. So there's all kinds of insurance. I think there's cyber insurance and other things and so many things, and we don't know what covers what and what events. Can you kind of break down the kind of things that we see, the common kind of insurance policies you have and what they do and don't do?
Yeah, definitely. So we'll start with the most common policies that everybody thinks of who owns a business. You have your general liability, your business personal property, and your workers' compensation. Your general liability is your slip and fall. Your workers' compensation, obviously injury to an employee during the course of their work for the entity. So those are the basics required by every property owner where you lease space from. Even if it's a shared space, they're all going to have general liability, various levels of limits and requirements there. And then the workers' compensation is a state mandated item. So you must carry those. Those are the easiest and most vanilla items or coverages within the insurance portfolio. Then as we dive in, and since we're talking about lenders and brokers, what everybody sees when they set up a relationship with a new warehouse facility, capital markets facility, Fannie Freddie, is a specialty mortgage banker's bond. And that is protection for those upstream entities in the event of a theft of their collateral. So bad loan, let's think about it that way. That's the easiest way to do it. The various warehouse facilities, they have different requirements in terms of minimum coverage amounts. Some it's 300,000, some it's 500,000. Depending on your volume and the size of your line, you could be up to 5-10 million, depending on who they are. And then obviously we throw in Fannie Freddie requirements, which is prior 12 months UPB, which is always a moving target. And right now, at least the somewhat of a relief we're seeing is that while volume is down, so therefore your rates can follow suit. Because you're not set to that requirement. I have the table on my desktop, so I always know how to plan when we're coming up for renewals or coming up for audit season on that. But then you go to the E&O, or professional liability, errors and omissions coverage, and that's the protection for your entity from downstream related claims. So for applicants, for people who have placed loans through you, if something were to go wrong within the process in terms of your representation, let's say rate, let's say payment terms, didn't verify the social and personally identifiable information and report it over to TransUnion, those are where you're going to see E&O claims stem from most of the time. We're going to move on now to employment practices liability. And that's a fun one, because when you think of employment practices, it's always your wrongful termination, your sexual harassment, hostile work environment. The other factors that are thrown in there right now, where the markets are seeing a little bit of hesitation in different states and due to the types of the operation, are the wage and hour defense cost sublimits. Somebody is relieved of their job responsibilities, let's say, and all of a sudden they can prove or make the allegation that they didn't receive their 15-minute breaks for the last 2.5 years. They worked through them, maybe voluntarily, but they didn't get them, and they're not on any type of report, they're not on any type of time card, and they're going to file a wage and hour claim. So you need to make sure that you have the defense costs in there. Some states, California, it's getting tougher by the week to include a wage and hour, especially with different industries, construction, financial institutions. Those are the two primary ones where we're seeing a lot of claims over the last 2-3 years. The other key item within employment practices liability is making sure your policy has both first party and third party coverage. First party, that is your employee or former employee files a claim against the entity. Simple. That's what the basis of the policy is. But the third party extension is also key. Let's say your mortgage insurance rep or another vendor comes into the office. Somebody makes an offhanded comment to them that they don't pay very lightly, or they're not very pleased with. And they get the idea to file suit against your entity. You're responsible for the actions of your employees. Without that third party extension on there, your entity will not have coverage. And that goes to defense costs, that goes to potential liability limits, everything. So just making sure you can get the broadest extension with first, third party, and wage and hour claims on a defense cost supplement there. Those are the key items with the EPLI. D&O, directors and officers liability. The directors and officers liability is probably the most comprehensive policy, because there's 3 different sides is what they refer. They have side A coverage, side B coverage, and side C coverage. So your side A coverage is the directors and officers. And again, there's some ways, and if you have relationships and work with a good broker, they're going to expand that out to and cover all employees within your organization, not just those individuals listed as directors and officers on your org chart. Okay. Those are claims that are indemnified, non-indemnified, and then side C is going to be entity coverage. We just came up with a review. We just performed a policy review analysis last week. I noticed that entity coverage was not included, and entity coverage is huge, because that's where your claims from your regulators, your shareholders, your antitrust claims from competitors. Back 4 or 5 years ago, we saw a few come through, poaching of competitors' employees. Well, they named the individual, so where are we going to pick it up? We're going to pick it up on side B, but they're also going to bring the entity in because it was under your advice or under your guide, even though it may not have been, that you wanted to go try to steal 50, 100 employees away from a competitor there. So having those 3 pieces and 3 sides within the D&O policy is huge there. The insurance policy that's most commonly talked about in the news and social media and media, everything, is the cyber liability. That has anywhere from 10 to 15 different coverage pieces in it. You want your social fraud. So somebody sends you a link and says, here, pay our invoice. It could be from a normal vendor, but somehow somebody breached their system, manipulated that invoice, and you just dumped $100,000 to an offshore account somewhere around the world. And now you don't have $100,000 and you have no recourse of getting that money back. The social fraud piece within your cyber policy is where you're going to lean on in order to be made whole for that loss. Your business income, your ransomware. your equipment in the event of a bricking related loss, your notification and monitoring expenses. Someone accesses your database and you have 250,000, 500,000 applicants and pieces of information in your system, you have to notify every single one. And if you don't have the notification and monitoring expenses outside of your $1 million, $3 million, $5 million policy limit, that's going to get eroded real quick with the cost of stamps from the US mail. And then also you have to offer them monitoring for credit monitoring for a year. I think it's right around $200 now per individual. So if you have an event like that, you're not outside the limits or have a separate limit at your normal policy. So 1 million for claims, 1 million for notification and monitoring expenses. Your original $1 million is gone real quick. So you need to build it out with different silos of the coverage there just to broaden it. And it doesn't cost anything else. It just boils down to having an agent, having carriers and underwriters that know this industry and know that what you need in order to protect your assets. Final item really is the license bonds. Josh and Ray both mentioned it. They're a fixed commodity. Every state requires it. Well, I don't say every state, sorry. About 42 out of the 50 states require it before you obtain a license or coming up for your license renewal. Set amounts, typically depending on what your volume was for the prior 12 months, they range from $25,000 up to $500,000, even $750,000 for DC. So working with that, knowing the NMLS system, that since they've been transitioning over to the electronic surety bond program, just having good responsiveness, you need to add a DBA, you need to issue an OTN bond for a different license, knowing the limits, knowing the carriers, having proprietary programs, proprietary rate guidelines. It's all huge, but I know I rambled off because this is like second nature, but that's a general 30,000 foot view of the insurance that's going to be required in this niche.
Thanks, you. So yeah, and now I was like, I thought there were only like 3, and I've known you for years, Michael. I thought, yeah, there's like 3 insurance: the bond, the E&O, and the D&O, right? Like, okay, we put a lot more, and this is why we like having you around. So again, the insurance I think isn't, and I don't know, every lender I suppose is different as to what coverage they have. If they have the coverage, some like the bond is required, otherwise you're going to get the license. I get that. Others I suppose are theoretically optional, run the risk if you don't want D&O, but you probably should have it. So I get all of that and something to have in place. So what it sounds like, and I think one thing, particularly again, having been in-house and managed risk before, is when something happens at a company, we don't even, the first thing, I shouldn't say that. We don't always think about, hey, what insurance coverage do we have for this HR issue, this buyback, this whatever it is, right? But I suppose we should probably get our insurance partners involved at some point. Does that make sense, Michael, insofar as seeing what coverage we might have since we're paying anyway?
Yeah, so communication is a two-way flow of information, and I can communicate what your policies are to you when we place new policies, when we come up for renewal. But if I don't understand, or your agent doesn't understand what's going on during that term and potential items that may come up, there's no way to have that conversation to say, yes, okay, we need to put carrier A on notice for this line of coverage based on the information you provided, or, well, we think this is a nuisance related item. It's going to go away for $5,000. We have our counsel on it. We're just going to have them sign a release and cut a check. Okay. Well, it just really boils down to, well, what's the validity or what's the information that's coming from the claim? Okay, is this something that's legitimate? Yes, then we need to engage your carrier now. We need to put them on notice so they're prepared. They have their arsenal built up. And when that formal demand comes over, they're ready to pounce on it and give a response in a quick amount of time. And plus, the claims are never simple on any type of professional or management liability. So it gives time. Okay, we put the carrier on notice. Well, let's start gathering all our evidence. Let's start gathering our notes. Let's start working on this to help expedite things when that demand comes through. We're not waiting until that demand, and then we have to go through all this, and we have a certain amount of days to get a response from the carrier to the claimant's counsel, and then everybody's scrambling. So if you can be proactive on it and work ahead of the time frame, that date at 12:59, somebody must receive a response or somebody must receive X, Y, and Z, then it just helps things go smoother during the process.
No,
Michael, just to,
go
sorry,
ahead,
Ray,
Raj.
just to clarify on a couple of points, because I think there's a couple of nuances there. One is almost like that requirement to notify, and maybe we can talk about that a little more. And then also the notions of kind of the first right of defense. Some of these elements that I think are part and parcel of the policies that have some timelines associated to them, or some, if you don't do it, you may lose some of the protection. Can you talk a little bit about that?
Yeah, so within all of the professional management liability policies, there will be a couple of paragraphs or a couple of items that relate to the time frame for claim notification. Some say when reasonably possible. Well, what is that? That's very arbitrary, and no one knows, or to my knowledge, hasn't tested what is reasonably in terms of a time frame there. But there are other items built in. Some of carriers have 60 days, 90 days from when you receive the formal demand. All carriers and all policies on that, they have a time frame set after policy expiration. So let's say you're made aware of an incident. You don't notify or don't discuss with your agent or the carrier on it. Policy goes through renewal. 2 months after renewal, here comes the formal demand. Well, they could hang their hat on there and say, sorry, since you didn't notify us within the policy time frame that you were made aware of it, or within the 60 days, 90 days, whatever the specific date timeline is on that policy, we're not going to provide representation for you. We're not going to provide defense, and we're not going to cover the claim. And then that's going to be a very tough conversation to have with the carrier, the agent, and the policyholder on there. So again, it just boils down to communication. Because if we turn this in, if a client calls me, we have a hypothetical question. Here's what's going on. We may be presented with this. We're not sure. Here's where we are within the stages of the process. Okay, well, if this seems valid and this seems like something is going to happen, let's make that carrier aware, and let's make them aware of it so they can prep. Again, it goes back to communication. And let's say we do that and nothing ever shows up in terms of a formal demand or in terms of a formal claim. It's no harm, no foul. The carrier didn't pay any money out. No dollars paid out and no penalty when it comes up, or no, I guess higher premium is what everybody will relate that to. No increases in premium when you come up for renewal. Even if we have 3 or 4 potential items, I have some people that I've worked with over the years. I mean, we get quarterly reports, we get border reports on these, and it's 10 to 15 items. Well, they all get washed away. Nothing ever comes to fruition. They're just nuisance. They're labeled in as a third party. And it's not a penalty when we come up for renewal. The underwriters don't bat an eye. They didn't spend any money on it in terms of the carrier. So it doesn't impact the loss ratio. It doesn't impact the underwriters, whether it's the incumbent carriers or potential alternate options, eyes of the operations. They know it's going to happen. And yeah, if we had something that did stick for 3, 4, 500 grand, then we're going to be looking at maybe exploring another market or maybe an increased premium. But notifying and the communication, the carriers appreciate that. The carriers don't want to get caught blindsided. And again, if it doesn't exceed the retention, it doesn't ever come to fruition in terms of the formal demand, then it's not going to be a topic when the renewals come up the next year.
Real quick, and you mentioned that, and you know where I'm going with this, but you mentioned retention. I know that as a deductible in my world of insurance. Does that make sense? Just want to make sure people understand when you say retention, you're talking the equivalent, what I would say is my deductible when it comes to insurance. Is that right?
It's similar, but the small difference there is retention is first dollar. So on a policy such as E&O, SMBB, cyber, D&O, EPLI, they're all going to list a retention on there. And that retention is the policyholder's first dollar responsibility before the carrier steps in and pays. So that's not you're on your own and we're not going to do anything for you until then. No, you're going to approach them with your list of preferred counsel. They're going to give their list of preferred counsel. You're going to work out the rates. You're going to work out in terms of hourly billing rates for those counsels. It's just involvement, and then the bills are going to come to the policyholder until we get to that $15, $25, $50, $250,000 retention point. And then after that, every dollar paid is from the carrier.
So what I'm hearing the two is is just, where your friends notify us, if you have a possible claim or maybe do hypothetical. And I'm hearing that it doesn't, it doesn't hit the premium in the future if we make more claims, et cetera. And I believe you on that. And that could change. That's for your experience. It could be different. Insurance companies have different mathematics and whatever. But anyway, I get that. But I think one of the threshold questions too is, how do we know when we're supposed to notify? In other words, what event? Is it a random email from a borrower that says I'm going to sue you, or is it something more formal or something in between? What do you think is that threshold insofar as people know, like, okay, now we should notify?
Yeah, so I mean, obviously, there's that when the letter shows up. But when the letter shows up with the formal demand, you better notify your agent. You better notify your carrier at that point in time, and not waste any extra days or any extra hours. But in those nuisance-related or threatening type of situations that you mentioned, or potential loss scenarios, somebody sends an email. No, we don't need to notify them every time somebody sends an email and makes a baseless threat against you and trying to shake you down for $4,000, $5,000, $10,000.
No, that would never happen in this industry. Never happens. But go ahead.
Yes. Just make sure you have a well-drafted release of liability if you decide to start paying those out of your pocket, so that they cannot, and have that reviewed by counsel. But when it goes to the, okay, Michael, this idea or something happened, this situation occurred, and now we got that email and our team's been researching it, and we think we might have been in the wrong, or we think we might have not included that document, or we think we might have sent it over to TransUnion, whatever the case is, without their permission, and this was just a fictitious loan or a fictitious application, then that's the time we really should start having a sit-down conversation, or a Zoom conversation, or a phone conversation about, all right, well, let's boil this down, and what do we think the probability are if we are going under the guise that there is some guilt or is some obligation. Then let's engage the carrier and go from there. But we don't need to send them every shakedown email or anything like that. No, it's just,
I get it.
If we think the matter's got some traction.
Josh, any final words, any final thoughts, questions?
Yeah, so two really. One, in my compliance world, I use this expression a lot. Bring me in early and I can almost always get you to yes. Wait until the end to bring me in and it's almost always expensive. Sounds like it tends to be true with you as well.
Yes. Again, communication and being proactive as opposed to reactive, like you said, Josh. That makes things a lot easier for the policyholder side, for my side, for the carrier side, for everybody's side, and it allows ample preparation for what may come about, or what may happen, or to say, okay, let's get the carrier involved, and we're going to send them a go away letter, real nice, firm, formal, and then the matter's done, as opposed to just letting it dwell on the list of counsel, compliance, whoever, to monitor it and wait and see if something happens 6-7 months from now.
Awesome. And just one more thought, as we're having this conversation, as we were talking before preparing, it made me think back to Robert Kiyosaki's book, Rich Dad, Poor Dad, which I can't believe is almost 30 years ago now. But one of the things that he writes in the book is the wealthy look at insurance as an asset, and everyone else looks at it as a liability. It certainly seems to be true here that regardless of markets, especially in a down market, we're looking to save cost everywhere. But it's almost short-term thinking to cancel a policy that's not absolutely required, because if something happens, that protection you're getting, really the payment is pennies on the dollar. And so it does really seem that, look, nobody likes writing a check, especially probably for compliance or insurance, until you really need it. And then you really see the value of what you're getting.
Yeah, and all that is more important now than it has been the last 3-4 years, because everybody's looking at bottom lines. So it's about finding that balance. We don't want to pay X amount of dollars anymore for this coverage. Well, here's why you should. Okay, but let's come to an understanding in terms of what is your tolerance for self-insuring, i.e. paying any potential claim out of your own pocket versus paying premium dollars. Maybe let's decrease the limit a little bit. Maybe let's massage the retention a little bit. But it just boils down to finding the value and making sure it works. Because obviously, if you guys told people they never needed compliance and I told people they never needed insurance, then we'd all be sitting here probably not having this conversation.
No.
But at the same time, we understand that right now it's tough again, and just finding that balance that makes sense from all parties involved.
Well, one last comment just for me, and then we'll wrap it up. And as Ray and I mentioned, we've had the fortune to work with Michael for a while now. And there was a client we were working with, and Michael reviewed their insurance policy. And after looking at it, fairly quickly realized their policy doesn't cover what they actually do. So they're basically paying for nothing. Went through and provided the right kind of coverage, the right type of insurance. And so I just really encourage those who are watching, know what you're getting. Have a true expert review the policy and the insurance that you have to make sure it's giving the right type of coverage. Nobody wants to pay for something for nothing.
Right.
Nobody wants to pay for most things, again, especially probably insurance or compliance.
You want to get something for it. Yeah, I want to get something.
Yeah.
No coverage.
But at least make sure that the insurance that we have covers the activities that we're performing. Otherwise, really, that's putting good money after bad.
Yeah, and the tough part of that too right now, we go back to the looking at balance sheets and looking at bottom lines, is everybody just focuses on that. Most insurance brokers in my industry, unfortunately, do the same thing. And while that is important, it's those 90 pages after the declarations page that tells you what your limit and your premium is. That's really important in the event that a claim comes up. So you want to have somebody who's going to read that. Somebody who writes one lender, one broker, has no clue what they're doing. No offense to anybody who may be watching this, that's them, but they have no clue what they're doing. They have no clue what you need in this industry. They have no clue as far as what the claims nuances are and what the triggers are for coverage. And sometimes it's as easy as just changing a single word within the definitions, and there you go, you have 3x more coverage for when a claim does come about. So just specialty like you guys are the gurus of what you do, and trying to be that on the insurance side.
We definitely are. So, well, thank you, Michael, for your time and kind of enlightening us and kind of straightening it out. And even then, you know me, with me and my clients, if we got something, I'm coming to you, Michael, so y'all can explain that stuff, because it is guru stuff that's beyond me, at least at that level of detail. So the insurance nerd, I guess maybe should label that the mortgage insurance nerd or whatever.
I'm going to copyright that.
Yeah, copyright it, because you admit to that. You fess up, man. You're the nerd when it comes to insurance or mortgage companies, and trust me, we love you for that. So. Thank you for your time and coming on here, we'll take it from there.
We'll be sure to post Michael's information here in the links below. As usual, please rate, subscribe, review. Michael, thank you so much for joining us, and we'll see you guys all next time. Thanks again.
Yeah, thank you both.
Thank you.